Hey guys, my name is Dhruv and welcome back to Trade to Learn. Today's video is really exciting because I'll be talking about one of the best ways to buy stocks, dollar cost averaging, also known as DCA. So if you're going to watch this video all the way through, we're going to talk about a few things. What is DCA, how it works, when to use it, and a slight downside. When you dollar cost average, you break your investment into pieces and put portions of your money into the stock market at equal time intervals, instead of putting all your money into the stock market at one time. This is another thing that we'll utilize when we start making our portfolio. To put this into perspective, here is an example. Say you narrow down to one stock, Robinhood Markets, and you want to buy $10,000 worth of it. But in your research, you realize that the stock is very volatile and you're not sure if you're buying it at the best possible price. So instead of putting all your money into it at one time, you could put $2,000 every month for 5 months, and this is what DCA is all about. Now, we'll talk about how DCA works. Dollar cost averaging works because it removes some of the emotional stress that comes with investing. By committing to a set schedule, you don't have to worry about whether a stock is about to move higher or lower. To go back to the example of Robinhood Markets, let's assume you buy $2,000 worth of its stock for 5 consecutive months. Let's also say that on the days you buy, the stock is trading at 50, 40, 20, 40, and 50. Over the course of those 5 months, the stock price ended up where it started, but it took a wild ride in the meantime. As you can see in the scenario, you would get 280 stocks. But if you had invested all your money at once, you would have only bought 200. This is not the same all the time, because if the stock had gone straight up, you would have got a lesser amount of stocks. Another interesting thing that we're going to talk about is the day to use DCA. There are a lot of fake investment experts who claim to be a specific days to invest in stocks based on certain market movements. Don't believe it. If there was a magical formula for picking out stocks each month, we'd all just buy then and not have to figure out our own strategies. However, the time that you dollar cost average is very important. Specifically, you must make a consistent plan and stick to it. A lot of benefit of the strategy comes from breaking your investment into chunks so you don't have to worry about when to buy in and not have to time the market. Therefore, it's important that once you make a plan, you stick to it no matter what happens. Obviously, there's a downside to everything. Before going with DCA, there are a few things you have to consider. For one, it's impossible to predict if a stock will go up or down on any particular day, month, or year. Also, if you park most of your money out of the market and only buy in a bit at a time, you avoid short-term volatility. But that also means that a portion of your money is on the sidelines and it's not working to build your net worth. Finally, note that any investment strategy is only as good as the stocks you pick. DCA might be better than timing the market, but it's no substitute for finding quality companies to invest in. That was all for today's video. Keep this in mind when we're making our portfolios. Stay tuned for our next video on stock splits, and see you next time!